My name is Joshua Morrison and I'm going to talk about Colgate-Palmolive. The aim of this presentation is to discuss how Colgate-Palmolive are incorporating sustainability into their business operations, and it is split into the following three areas. Firstly, I'll explore corporate governance and the role the board of directors play within Colgate-Palmolive. Secondly, an investigation of socially responsible investments, or SRIs, will be done to identify the extent to which Colgate-Palmolive utilise them. Finally, an examination of the company's strategic investment decisions utilising SRI will be done and explore the value created from this. So, a little bit about Colgate-Palmolive. The company was founded in 1806 in New York as a soap and candle supplier. During its 200-year history, the utilisation of competitiveness and expansionary-based business objectives have amalgamated Colgate-Palmolive into a multi-billion-dollar company operating in over 200 countries. The principal industries this organisation operates in are home and personal care, offering a plethora of household brands such as Colgate, Palmolive, Sanex and Ajax. Corporate governance was adopted by companies to combat a loss of confidence in company managers by shareholders. Corporate governance has been defined in a multitude of ways, but I believe the following is most apt. It is a system of rules, practices and processes through which a company is directed and controlled whilst balancing the interests of its stakeholders. A country's corporate governance system has a significant impact on the profitability and growth of the company, their access to capital, their cost of capital, decisions undertaken by the firm, and ultimately the wealth created by a country. The PA model can be used to explain why corporate governance practices are required. The idea is that humans are inherently self-interested and are disinclined to put the interests of others ahead of themselves. Therefore, a board of directors try to correct the agency problems the PA model brings. Colgate-Palmolive addressed this agency problem by having long-term incentives which reward directors with stock compensation to both pay them for their commitment but also make sure the company's best needs in mind. This is further outlined by their consistent testing of practice and regular performance monitoring. However, it's my opinion that due to the one-year term that each board member participates in, this might not be a long enough amount of time to justify a long-term view. It can be argued that Colgate have in fact transitioned towards a stewardship theory as an alternative to the agency. They adopted stewardship code to enhance the quality of engagement between asset managers and the companies to help improve long-term adjusted returns to shareholders. In this, the trust is developed between ownership and management with the assumption that both parties will perform to satisfy stakeholder interests. The ideology is that employees are not held accountable for their actions, as this would indicate control in some degree of agency theory. However, their compensation is embedded in the company's success. Employees within Colgate are quoted as being respected and represented in regular meetings in which employees, managers and board members discuss and attempt to reconcile differences informally. With reference to corporate governance, the divergence or convergence of practices is a heavily debated topic. Considerable differences exist across countries in the corporate governance mechanisms. The corporate environmental characteristics affect corporate governance practices, therefore, corporate governance changes simultaneously with the environmental changes, according to Gillian and Starks. My research into Colgate-Palmolive's corporate governance standards suggests they follow a convergent approach in which they attempt to align their regulations across all territories in which they operate. This is supported by existing literature. The model they follow is an American-based model of corporate governance in which they follow American litigation, and these regulations are utilised across all their global operations. The regulation has been structured in such a way as to provide a relatively consistent information to their investors across all subsidiaries. The company are identified as following a stakeholder approach in which they attempt to satisfy the needs of all those in which the company operate. The company are dedicated to a triple bottom approach in which the environment, society and their business are thought to be equally important. They place emphasis on the 3 Ps: people, performance and planet. They have initiatives to make sure their employees follow the sustainable practices via compensation. MacDonald and Puxty explain how companies are the instruments of society and not just shareholders. Through maximising the wealth of all stakeholders, not only will the company be in a better position, but so will the shareholders, implying that shareholder wealth maximisation can only be achieved when all stakeholders are better off. To ensure the company follow a stakeholder approach, Colgate-Palmolive have a diverse board of directors, and in compliance with US regulation, over half are independent non-executives. This means that they have no affiliated ties to the company. They're aligned with the SOX, NYSE, and NASDAQ regulations. In fact, Colgate-Palmolive have such faith in the effectiveness of the independent directors, they have set forth more stringent regulations than the SEC have asked for, in which all of their board members are independent by the CEO. The main role of the board is to play as to oversee the Colgate's business strategy. It reviews the company's strategic plan and receives detailed briefings throughout the year on critical aspects of its implementation. The directors themselves are also shareholders, which means they're constantly striving for the best results of the company. Finally, the board believes the company has consistently been at the forefront of good corporate governance. Reflecting its commitment to the continuous improvement, the board reviews its governance practices on an ongoing basis to ensure they promote shareholder value. Moving on. Now, because Colgate-Palmolive are both a publicly traded company and operate and are headquartered within the US, they must disclose their information. Now, disclosure refers to either the mandatory or voluntary release of information about a firm's financial position and performance. Companies that disclose information benefit from a lower cost of capital as well as higher investor and shareholder confidence. Now, as mentioned, Colgate-Palmolive are headquartered within the US, and therefore they must report using SEC disclosure obligations. Now, this refers to publicly owned companies disclosing business and financial data. The data must be made available to all shareholders and also potential investors when new securities, such as stocks or bonds, are issued. Moreover, being within the US, they must follow the Sarbanes-Oxley Act, which increases the accountability of the board of directors, increases the company accounting oversight, and also increases penalties of crimes against stockholders and stakeholders. Evidence for the improvement of disclosure within Colgate-Palmolive can be seen in their annual report, which has increased 27% since 2011. To finalise this section on corporate governance, it is apt to deduce the effectiveness that this standard has on competitiveness. Now, according to existing literature, companies that implement high levels of corporate governance and better CSR practices have high levels of profitability and better performance. Now, the following is a list of benefits that are attributed to companies that implement good corporate governance practices. However, in reference to Colgate, these benefits have been proven. However, there have been instances where corporate governance standards have slipped within Colgate. The following are two scandals within the company. So primarily, Colgate was accused of deceiving consumers and shareholders about the procurement of palm oil, which is used in a plethora of their products. Amnesty International voiced that the material was retrieved using unsustainable practices and using child labour. Moreover, Colgate was found to have taken part in price collusion on several of their products in Australia. This had a severe impact on the shareholders and also the stakeholders involved within the company. So now I'm going to discuss part 2 of the presentation, which is socially responsible investments. So SRIs are an investment process that considers the social, ethical, and environmental consequences of an investment as well as their financial performance. Now, social responsibility is an important subject because between 2000 and 2013, social investment grew by 900%. To it, 1 in every $9 under the US economy can be classified as an SRI. This then grew to 1 in every 6 in 2014. Now, the value of SRI funds have increased significantly globally, and this has led to the creation of SRI indices such as the FTSE for Good, the Calvus Social Index, and the MSCI KLD Social Index. Under the umbrella of SRI, there are a number of theories. So primarily, there is common shareholder wealth maximisation. However, as stipulated earlier, the focus on shareholder wealth alone is not one that Colgate is focusing on. Instead, they aim to perform in such a way that values the stakeholders together. A theory within SRI that aligns with this is the instrumental stakeholder theory, which denotes a way in which a firm maintains its stakeholder impact determines the financial effect on the company. Evidence of Colgate doing this can be seen in the sustainability report, which outlines the various endeavours it takes to impact upon chosen stakeholders. However, it could be argued they do this in such a way because they have the resources available to do so. This would fall into slack resource theory, i.e. because Colgate is a $64 billion company, it has a vast amount of resources to pump into SRI. It is questionable whether this is a marketing platform which other companies can't match because they don't have the resources to match Colgate. Finally, it could also be argued that they adopt a halo theory approach, which Thorndike conceptualized as being a way in which an entity it's judged by the last ethical decision they made, whether this is positive or negative. Now, examples of Colgate doing this can be seen after the palm oil disaster in 2016. Now, following this, there was a sharp decline in the ESG rating of Colgate, and as such, the company immediately invested large swathes of money into social projects around their subsidiaries in India, China, and even the US. Following this, ESG rating rose rapidly, which suggested that this was a very impactful theory under the SRI umbrella. Furthermore, Colgate has been recognised as a top 25 socially responsible dividend stock with a strong 2.2% yield. Moreover, the ETF identified that Colgate was within the MSCI KLD 400 social index, making up 0.89% of the underlying holdings of the fund. Now, this social index is a capitalisation of the weighted index of 400 US securities that provides exposure to companies with outstanding environmental, social and governance ratings, and excludes companies whose products have negative social or environmental impacts. For more information about the ESG metrics of Colgate, refer to Appendix 1A and 1B. Since its inception, there has been debate about the effectiveness of SRI on a company's performance. Now, there's been a plethora of studies done that shows the effectiveness that an SRI has on a company's performance. The following are a list of examples. So Kempf and Otham found that an abnormal return of 8.7% can be earned by buying high SRI stocks and shorting conventional stocks. Hill et al. Deduced that the SRI stocks outperform non-SRIs in the long run or over a 10-year period. Consolandi et al. Found that the SRI's indexes slightly outperformed conventional indices in most economies, and Brzezinski found that during 2000 to 2010, the performance of SRI portfolios were higher on average than conventional ones. However, there have also been contrasting views on the effectiveness of SRI stocks on a company's performance. Menard et al. Found that there was no statistical difference in the mean returns of SRI against conventional indices. Moreover, Runenburg et al. Found that in an international study of SRI stocks, there was an underperformance against the domestic stocks. Schroeder et al. Found that there was no significant over or underperformance against conventional indices, and finally, Scholtens found there was no difference in risk-adjusted returns on SRI funds. Now, the question is, which one is correct? Now, SRIs can affect companies in different ways, but one possible explanation, which was identified by Kempf and Otham, was that SRI funds managers may be more skilled than conventional managers, and therefore the SRIs may not actually affect a company positively, but rather the management style that it reflects does. The following section refers to investment value creation. Now, value creation refers to the performance of an action in order to improve the worth of goods and services within a given business for consumers and shareholders. It's the primary aim of any company and has been increasingly recognised as an optimal management goal. Now, there are a number of techniques a company can adopt to make a strategic investment decision to increase both shareholder wealth and stakeholder value. Now, investment appraisal techniques provide major operational and strategic objectives for managers and decision makers. They help to aid in the decision behind projects. One such appraisal technique is economic value added. Now, this is a measure of a company's financial performance based on the deduction of its capital costs from its operating profit. Now, another technique is to take into account shareholder value analysis. This technique was developed in 1980 to create economic value for shareholders. It focuses primarily on shareholder wealth. However, in order to calculate this figure, expected cash flows are needed, which can give very misleading results when making strategic decisions. This is mainly because volatility and uncertainty are hard to account for. Moreover, there is the Boston Consulting Group matrix, which is utilised to allow companies to effectively allocate their resources. Now, within Colgate, there are three main areas, and these are personal, home care, and pet health. Now, it's my belief that the company should stop focusing on pet health and relocate their efforts to personal care instead from pet food due to the fact that the growth in this sector is slowing down. However, these techniques are only used as a relatively subjective method of directing a company. Therefore, they need more analytical investment tools to determine the value, where the value may be added through different projects. One such analytical method is NPV. Now, NPV is a great way to test different projects based on future outcomes. However, as discussed previously, One such flaw is that it requires future cash flows which are highly subjective due to the unpredictable nature of volatility and uncertainty. However, in reference to Colgate, we can utilise NPV. Now, Colgate are intending to invest £2 billion in a manufacturing plant in India. They're doing this to protect against market share loss as new entrants come into the market. Based on the information we've gathered so far, we can deduce that they expect to retain the same cash flow in line with the growth rates of 13%. The current market share is around 55% and the market value is 646 million, meaning that currently the expected cash flows are 448 million for Colgate. Having found that the weighted average cost of capital is 6.95% and the project is expected to last 6 years, we can calculate the NPV equals 719.412 million. This is just one appraisal technique that managers and decision makers can use to deduce whether a project is worth doing or not. However, as discussed earlier, this does have its flaws, mainly that due to the fact that you need future cash flows, it can be highly subjective due to volatility and uncertainty. To conclude this presentation, I believe the following sections have been covered. There's been corporate governance, SRIs, and investment value creation. Now, in reference to corporate governance, Colgate have very good corporate governance practices that are incredibly stringent. They have a firm stakeholder view, and these are consistently monitored to ensure absolute effectiveness. In relation to SRIs, Colgate have varied ESG rating over the past 5 years. They're within the top 25 social responsible stocks and are part of the MSCI KLD social index, although, as discussed, there have been some scandals. And finally, investment value creation. There are several appraisal techniques that can be used, and NPV was implemented to show the possibility of the project within India. Thank you for taking the time to watch this presentation, and I hope you've enjoyed.